All right. Good morning, good afternoon, traders. Today is Wednesday, May 7th, 2025. This is You've Got Options for Income Navigator. Today, we are going to talk about just a general idea why we use options for trading. There are many different ways we could take advantage of the financial markets. We can trade stocks, we can trade futures, we can trade bonds, mutual funds, whatnot. But we are here where, for the most part, we are trading options, and we are going to talk about some of the benefits why we choose primarily to trade options. Before we get started, quick disclaimer. Today's presentation is for educational and or entertainment purposes only. This is not a financial advice. Everything we're going to discuss today is for your own consumption, hopefully to learn something new. You should always do your own research, consult with your financial advisor before making any investment decisions. If you are here looking for financial advice, I want to warn you that you are in the wrong place. With that being said, let's get started. So today's lesson is why use options. Our objective for today to gain understanding of key reasons to use options in trading and investing, including benefits, strategic advantages, and practical applications. Real quick, for those of you that are not familiar, options are a very versatile financial instrument that gives us the right, but not the obligation, to buy or sell an underlying asset at a specified price, also known as strike price, before or at expiration. Now, I want to highlight something real quick. If we sell an option, that does give us an obligation. But for the most part, if you buy an option, this gives you the right. You're not obligated to do anything, but you do pay for the right to buy or sell an underlying asset at a specific price by a specific date, which is also known as expiration date. Options are a very powerful tool to achieving various financial goals, from generating income to managing risk. I think for the most part, we're all here concentrating on, I guess we can say we're trying to achieve both, but for the most part, we're trying to generate income while we're trying to manage our risk. We're going to explore why options are a valuable addition to our financial toolkit. One of the first things, and I think this is very important, most people, when they think about options trading, first thing comes to mind is the leverage. Leverage amplifies returns with less capital. Options allow us to control a large amount of underlying asset, could be stocks, ETFs, or indexes, with a relatively small investment, also known as premium or time premium or extrinsic value, if you will. As an example, if a stock is trading at $100 a share and a call option with a 100 strike price is trading for around $5 for one contract, and one contract controls 100 shares, instead of paying $10,000 to buy the 100 shares, right? Stock is at 100 times 100 shares, it's $10,000. So instead of putting up $10,000 to buy 100 shares, we only have to put up $500 for that option. Option is trading for $5, right? Times 100 shares. One contract covers 100 shares of stock, so 5 times 100, we only have to put up $500 for that option. If the stock rises to 110, the option might be worth $10, yielding a 100% return on your investment, right? It's a $5 profit on the $5 invested, or $500 profit on $500 investment versus a 10% return on stock, right? If the stock goes from 100 to 110, if you own 100 shares, stock goes up 10 points, you only make $1,000. So we do get a significant amount of leverage by buying options, right? The stock goes up only $10 or 10%. Our option could be up as much as 100%, while if you were holding just 100 shares, you would have only made about 10% return on that $10,000 invested. Leverage amplifies gains, making options attractive For those with limited capital, right, this applies for traders with smaller accounts or seeking higher returns, right, for those that want aggressive returns with limited capital, though it also increases risk. So on the flip side of this example, right, if the stock is trading at $100 a share, you can buy the 100 shares and put up $10,000, or you can buy a call option with a strike price of 100 and pay $5, or it's $5 for the contract, or total of $500. Now, when the stock rises, right, we see that we can potentially make a lot more, right, owning the call option versus buying the shares, right, in relative terms. But on the flip side, on the flip side, we also gain a lot more risk to the downside by trading options. What it means is that if the same stock goes from 100 per share to $90 a share, right, it falls $10 per share. The option may be trading for $3 now. That's a 40% loss. If the option with a strike price of 100 went from $5 to $3, you will have essentially lost 40% of your invested capital versus a 10% loss if you were holding 100 shares of the underlying stock. So leverage works both ways. It's great when it works in your favor, and it sucks when it doesn't. So we all need to be aware of that. I think this is one of the main reasons why a lot of people go to options to speculate, right? You don't want to speculate with hundreds of thousands of dollars. Maybe you don't have it. Maybe you don't want to risk it, right? So you know that going to buy a call at the money, out of the money, maybe slightly in the money, you know exactly what's at risk, and if your whatever your whatever bet you're making, if it works out in your favor, you will obviously make a better return through options versus buying the underlying security. Now, the next reason why we trade options is to manage our risk or protect our portfolio. Options can act as insurance to hedge against adverse price movements in our portfolio. For example, we can buy a protective put. Buying a put option allows us to sell a stock at a predetermined price, limiting our downside risk. And this is a really important and a really good example here. If you own 100 shares of stock at, let's say, $100 per share, a $95 put gives you the right to sell the stock at $95, even if the stock drops to 80. What does that mean? Let's say you bought a stock at $100 a share and you said, you know what? I think the upside is at least 20 to 30 points, but on the downside, I don't want to risk more than, let's say, $5. I'm going to buy the stock. I'm going to put in a 5-point stop loss, right? And let's see what happens. Well, if you have a stop loss in place, let's say you bought a stock today, the following day, tomorrow, stock opens down 20 points and now it's at 80. Well, what happens to your stop loss, right? Your stop loss at open will be triggered and it becomes a market order. And if the market is, let's say stock is indicating, $80 and the bid ask is maybe it's 79.50 by 80.50. Well, you're not getting out at 95. You're getting out at whatever the market is. And odds are, if you are selling at market, you're selling your 100 shares at 79.50 or whatever the highest bid at the time is. So your $95 stop loss is going to trigger and it will become a market order. You're not getting out at 95. 95 for a stop loss is just a trigger. Now, if you said, you know what, I'm not going to use a stop loss, I'm actually just going to buy a $95 put, right, that maybe expires in 2 months. When you walk in and the stock is trading at 80, you don't have to panic because you have the right to exercise your put and get out of your 100 shares that you bought at $100 a share at $95, only, right, only losing about $5 plus whatever you pay for the right to sell the stock at 95, also known as the time premium. So using options, this is a very smart way to use options. Instead of using stop losses, if you are trading individual stocks or if you have positions in your portfolio, um, and if the market gets a little iffy, and if you wanted to put a bunch of stop losses on your individual um, stock positions, instead you can use put options to limit your downside. It does come with a cost, right? You have to pay something for that $95 put, but it definitely eliminates a scenario where the stock gaps way below than what you were willing to sell your shares at, and potentially exposure to much greater downside than you wanted to. Also, portfolio hedging is another great reason to use options. You can use index options such as SPY, QQQ. You could also use SPX or whatever other index, right, that you want to use. You can use it to hedge against a broad market declines, right? Let's say you have, 20 individual stocks that you have in your portfolio. Instead of going out and buying a bunch of put options on each and every single position you may own, right? You may want to beta weight all of your positions, or maybe you're very exposed to one specific sector. Maybe it's technology, so you'll use QQQ. Maybe it's SPY. Maybe you're heavy in energy sector, or whatever the case may be. Right, you can beta weight all of your positions, right, your portfolio, against one individual index or an ETF, perhaps, such as SPY or QQQ, and you can figure out your directional risk and use options in the underlying index or an ETF to hedge against near-term market declines. Maybe you don't want to sell all of your individual positions. Maybe you're in it for the long run. But in the meantime, if the market's getting weaker, if there's some news coming, or maybe we're, going into a recession for the next 6 months, whatever the case may be, instead of selling out of your long-term positions, right, you can go to index options and use index options to hedge your overall portfolio. So hedging with options can protect gains or minimize losses without selling your underlying assets, offering peace of mind in volatile markets. You can also use, right, for portfolio hedging, and this is not necessarily hedging against the downside, but maybe you own, for example, if you have been writing Magnificent Seven stocks for the past, I don't know, 3 or 4 years, right? They've gone up a lot. And now we're kind of in a place where, you think that near term there isn't going to be as much growth, right? These Teslas and Nvidias and Apple and Google and Microsoft and whatever else, right? They don't pay big dividends. You don't want to sell them. You know that the upside may be limited, right? So you can possibly look to sell some out of the money calls to generate near term income. And that is also going to help you, right? If you sell out of the money calls for the next 6 months, bringing in the premium, that premium you're collecting is going to go towards offsetting your cost basis on your core holdings. And that is where we go into the next reason why we trade options is for income generation, right? We want to earn income. Selling options allows you to collect premiums, generating income in a flat or trending markets, right? Trending markets meaning we're rising or we may be um, moving even to the upside, right? If we're moving to the upside, but in a trend, meaning we go up and then we go down, and then we go up and we go down. But when we go down, we don't go down as much as we did on the previous dip, right? So there's an overall kind of drift higher. So you don't want to maybe, get very aggressive with premium collection. But in the meantime, you say, you know what, if I can generate an extra, 6 or 7% a year while I'm holding on to some of these tech stocks that I'm in for the long run, Selling out of the money calls could be a great way to generate short term income while playing for potential capital gains for the long run. Covered calls, as I had mentioned, if you own 100 shares of stock, you can sell a call option against it, collecting a premium. If the stock stays below the strike price, you get to keep the premium and the shares. That is the best case scenario. Now, it gets a little tricky, right? If you own, let's say, a stock at 100 and you sell a 120 call, and for whatever reason, right, we're not melting up or we're not drifting higher, but there is a spike in the price of the underlying, and let's say it goes to 130, your 120 call is now in the money. You're facing a decision. You can either let the stock go at 120, realizing, potentially a capital gain, and then having to deal with, the tax consequences, or maybe you want to replace you're going to get called away. So maybe you need to buy up 100 shares, let your broker know that the 100 shares that are getting called away, it's not the shares that you had bought 5 years ago, but it's the shares that you bought just now recently. So therefore, you can minimize your tax bill and whatnot. But covered calls in general are a great way to generate short-term income against your long only portfolio. And over time, right, if you do it for 6 months, if you do it for 8 months, all of a sudden, if you can reduce your cost basis by as much as 10%, in 6 to 8 months, it's a great way to enhance your long-term returns while maintaining your long only exposure in your underlying positions. Cash secured puts. I asked this earlier today on Discord. Why do you guys trade options? And there were some great questions, all within the topics that we're going to cover today. Cash secured puts is a big one. You know who else does cash secured puts? Warren Buffett. If you want to buy the stock that's trading at 100, but you don't want to pay 100 for it, you want to pay 80 for it, right? You can wait until it goes to 80 so you can buy the stock, or you can sell an 80 put that obligates you to buy the shares at 80. But in the meantime, before it gets to 80, you get to collect the premium. So you're generating income, short term income, until and if you get assigned. Maybe you can sell that, you know, out of the money put that's 20% out of the money for the next 8 months before you will eventually get assigned, right? But you were willing to buy the shares 20 points below the market to begin with. So instead of waiting and not earning anything, you can sell a cash secured put. You just have to make sure you have the cash to fulfill your obligation. You sell a 80 put for a stock that's trading at 100. Maybe you collect $2 for that contract or $200 in total. And well, you can do some quick math, right? Stock is at 80. You will have to put up $8,000 to fulfill the obligation of owning 100 shares at 80, right? But if you collect $200, maybe you sell a put 2 months out, you collect $200 and you had to put up $8,000 for it. Well, that's a 2.5% return on that $8,000. Maybe you did it over 2 months. And then if you extrapolate this over the course of the year, you're probably looking somewhere close to about a 30% return on capital, right? You had to put up $8,000 to grab the $200 over the next 2 months. If you don't get assigned, you get to keep $200. If you collect $200 over 2 months and you do this 6 times in a year, right? You will have collected $1,200. You divide $1,200 by $8,000 that you had to put up. That's about a 15% annual rate of return without having to own the shares, right? So that's a great way to generate short-term income. Great way to generate short-term income without actually owning any shares. Selling options provides consistent income, ideal for income-focused investors or those looking to enhance portfolio returns. Cash secured puts also is used in one of the strategies that we talk about, and we've talked about this quite a bit recently. Whether it's the wheel or a covered strangle, right, where you have to put up some capital, You have to commit to potentially buying shares at a lower price, right? You generate income. Maybe you already have 500 shares of Apple and you would be willing to own another 500 shares, but at lower price. Well, while you're holding on to the 500 shares, let's say the stock is continuing to drift higher, right? So your portfolio is increasing in value. That's a good thing, but you only have 500 shares. And if you're selling cash secured puts to potentially acquire 500 more shares, maybe you never get assigned, but while you're waiting for the stock to pull back so you can buy 500 more shares, you are enhancing your portfolio returns by collecting some of the additional premium. Options also give us a lot of flexibility. And this is one of those things that I talk about a lot. Hopefully, you guys think about options, not just, buy a call, stock goes up, I make money. Buy a call, stock goes down, I lose money. It doesn't have to be that way. Options offer a lot of flexibility, enabling strategies for bullish, bearish, neutral, and or very volatile markets. For example, in bullish markets, you buy calls or you can sell puts to profit from rising prices. This was one of my biggest challenges when I first started trading options, right? If I'm bullish, do I buy calls or do I sell puts? Maybe you do both, right? It all depends on your near term outlook on volatility. Same thing on the flip side. If you're bearish, do you buy puts? Do you sell calls? Maybe you do a combo where you buy a put and to finance or offset some of the cost of that long put, you can sell some calls to bring in a premium to reduce cost of these puts, and you will benefit from falling prices in the price of the underlying asset. What if you're market or direction neutral? You can use strategies such as iron condors. You can do straddles or strangles to profit from low volatility or range bound markets. Let's say the market has gone up quite a bit, and now you're not looking for market to roll over and completely die or to crash. Maybe you're looking for some kind of a sideways consolidation. I think strategies such as iron condors, which is essentially the same thing as a strangle, except iron condors are a defined risk trade, right? So if you don't want to take a ton of risk up or down, you can define your risk by doing an iron condor. If you are more advanced and you wanted to take advantage of rapid premium decay and or falling volatility, you can use strangles. If you want to get super aggressive, if you're looking for a very tight range, you can go to straddles. And if you don't want to do naked options, but you want to take advantage of rich premiums that may be at the money, instead of doing straddles, you can use butterflies. And you will profit from a low volatility. And I want to highlight low volatility is key, right? If you're anticipating market to continue to move in a big way, then maybe iron condors, straddles, and butterflies is not your best bet. Volatility. You can use straddles or strangles to profit from large price swings, regardless of the direction. Now we're talking about being a net option buyer. Instead of selling options to collect the premium, let's say you have a stock that hasn't done anything in 4 weeks, and you know that this isn't a normal behavior for whatever the underlying may be. You are anticipating some kind of a move up or down. Maybe it's a pre-earnings run, right? Maybe there's some sort of uh, FDA decision that's coming up, and you anticipate a big outside move outside of the priced in range. You can use long straddles, right? Buying an at the money call and buying an at the money put, or strangles if you're looking for a really, really big move up or down. Then you go out of the money on the long call and the put, and you will profit from a large price swing, regardless whether it's up or down, as long as you cover the cost of your straddle or a strangle, right? So options will let you adapt to any market condition. Unlike stocks, where you bought 100 shares, stock goes up, you'll make money. Stock goes down, you lose money. Same thing on the flip side. If you're short 100 shares, stock goes up, you will lose money. Stock goes down, you will make money. With options, you can buy a call, and if the underlying is moving against you, well, guess what? You can go farther out of the money and sell two calls out of the money, right? You're taking on upside risk, and whatever premium you're collecting, you may not only offset the cost of your long call, you can actually generate net credit for your position. So now all of a sudden you flipped from being bullish to neutral to slightly bearish, right? So options give us a ton of flexibility. We can turn straddles into butterflies, right? If the market isn't moving and we wanted to cut off our risks, you can also go from if you have a long put and you're a bearish, all of a sudden stock continues to move higher, right? There are ways, maybe you buy two calls and maybe you convert your long put into some kind of a spread, but there are ways to change the structure of your trade where you go from bullish to maybe neutral to slightly bearish. Whereas if you just own 100 shares of stock, either you own 100 shares or you don't, right? So stocks don't give you as much flexibility, options do. Another very important aspect here is you get to define your risk and you can control your exposure. Many option strategies have predefined maximum losses, allowing you to manage your risk effectively. Now, we talked about you buy a call, let's say stock's trading at 100, you buy a call, that call is going for $5. You know that if you bought that option and you paid $500 for it, no matter what happens, the stock goes to zero, you cannot lose any more than what you had paid for it, right? So you defined your risk by knowing exactly what you have to put up. And in the worst case scenario, if the stock goes to zero, or maybe if you had bought a put for $5, you put up $500, and let's say the underlying, if the company gets bought out at a much higher price, the most you can possibly lose is the premium that you paid for that option, right? So when you're buying options, you buy a call or a put, your maximum loss is limited to the premium you paid, regardless of how much the underlying asset moves. You can do a spread to reduce your cost of your option, whether you buy a call or you buy a put. If you do a spread, right, where a vertical spread is where you long a call, let's say you bought a 100 call and then you sold a 105 call, you essentially created a $5 spread, right? Buying a call by itself for $5 versus buying a call for $5 at 100 strike and then selling a 105 for maybe $2, right? You collect two, you spend five. Now your spread is only going for $3 or $300. So by doing spreads, you get to reduce your cost basis, but you're also potentially giving up some of the upside. So vertical spreads can cap both potential losses and gains, right? So you understand exactly what's at risk, right? What's your worst case scenario? And then you also know what is your best case scenario. For example, if you bought a 100, 105 call spread, stock goes to 120, well, you can't make any more than $5 because that's what your spread is. You bought a 100, sold a 105. The distance or the difference between the strikes is $5, right? Minus $3 that you paid for it. The most you can possibly make here is only $200. So you know what your risk and you know exactly what your reward is. And that goes for spreads. Defined risk makes options appealing to cautious traders who want to participate in the market without unlimited downside. I think this is pretty important because some of the newer traders, they get excited, especially when the market is easy, right? There were times think 2021 maybe, right? You could have bought anything and it all went up, right? Next thing you know, if you're newer and you're not really familiar with looking at trends and then identifying, some potential red flags where things can turn, or you don't really pay attention to implied volatility and how expensive, relatively speaking, options are. Next thing you know, you're buying calls that are going for, $30 or $3,000 a pop. It only takes a couple of down days, and you're down 90% in a small account, and that pretty much wipes everything out. So if you wanted to define your risk, right, you can create a spread, right? You know exactly what your downside is. You know that you're limiting your upside, but also on the downside, your risk is not as great. So I think that's very important, understanding the defined risk aspect. This is probably one of those reasons why most people get into the market or get into options trading to begin with, which is speculation, also known as profit from short-term moves. For example, if you know that a company ABC or XYZ is going to release earnings, right? You don't know if it's going to be good or bad, but someone told you that, every time this company releases earnings, the stock is up X amount, and you said, okay, you know what? I think this is going to hit, whatever the case may be. You don't want to buy the shares because it'll take, significantly higher amount of capital to get involved. Plus, if the earnings play doesn't work out and the stock goes the other way, you can potentially be in trouble. So you say, okay, you know what? I'm just going to buy, an out of the money call. If it hits, maybe I'll make 5, 10, 20x return on what I have to put up. But if it doesn't hit, I'm out 100% of the premium I'm paying for it. I'm fine with it. My risk is defined, and that's how I'm going to play this. That is the textbook speculation using options. So options are ideal for speculating on short-term price movements. Whatever the reason, we don't care. The reason why the price movement is going to happen, it just has to happen in a very short term, especially around events like earnings or economic data releases, right? So for example, if, like today, the Fed, we already knew that they weren't going to move, but we were trying to pay attention, what their stance or what their view on the economy, at least for the near term. And let's just say that there was a rumor, or we were well overdue for the Fed to make a move, and you thought the market was mispricing the odds of Fed cutting rates, right? Maybe if they cut rates, you thought the market was going to jump. Perfect opportunity, whether it's SPY, SPX, or whatever else that you think is going to move. You buy a very short term option, could be a put, could be a call. You probably know that if it doesn't work out, there is going to be no time to make any changes. You're pretty much 100% of the premium you're paying is at risk. You're willing to take that risk, but if it works out, you could benefit quite a bit from this short-term play. So that's one way to use options, purely to speculate on near-term price moves. The reason why it matters is because options allow you to capitalize on high probability events with limited capital, offering high reward opportunities for skilled traders. Another reason why we use options is for cost efficiency. And I think this also could be um, addressed as leverage, perhaps, right? Options provide exposure to expensive stocks or assets without owning them outright. As an example, instead of buying 100 shares of a $500 stock, right, which would cost you $50,000 if you wanted to buy 100 shares, you can buy a call option for only $2,000, right? So instead of putting up $50,000, You can only put up $2,000 by buying a call option, gaining similar upside exposure for a fraction of the cost, right? So essentially, by using a call option instead of buying the stock outright, you're you're getting about a 25 to 1 leverage. Now, you can make the case that, if you bought a call option for just $2,000, it isn't the same as owning 100 shares because odds are this $20 call is out of the money, which does not have 100 delta, right? So you're not necessarily gaining the same exposure delta wise, right? But in a sense, you do get to control potentially 100 shares of stock for only $2,000 because if that $100 stock, right, goes from 500 to 700, right, your call option is going to increase in value quite a bit. And then you have the right, not an obligation, but the right to exercise your call, get long stock, right, at whatever the strike price was. Maybe it's a $500 strike. So you get to control 100 shares at 500, except you didn't have to put up $50,000 to do it. You only had to put up $2,000 to do it. So options make it very affordable for high priced stocks like Apple, Tesla, Amazon, right? Think about when Tesla was $900 a share, when Apple was $700 a share. Anybody remember when Amazon was $3,500 a share? It was kind of tough to get long 100 shares of Amazon at $3,500, right? This was all before the stock splits in 22 or 2023, whenever they did that, maybe 2021. So when these and everybody wanted to own these, right? These were growth stocks. They were moving quite a bit. They were very strong. It was just very tough to get long 100 shares of Amazon at $3,500 if you have a $15,000 account, right? Sure, you can buy, less than 100 shares, but if you wanted to utilize the leverage, right, you could have gained almost as much exposure as owning 100 shares for a um, fraction of the cost or fraction of how much money you had to put up to get involved. Now, practical considerations. While options offer numerous benefits, they also come with risks and complexities, right? Time decay. We all know about time decay. If you are a net option premium seller, you will have time decay playing on your team, right? It's working in your favor. If you sell an option, right, every day we know that options are a wasting asset, right? They don't have any real value until they are in the money at expiration. If an option is in the money at expiration, then that option actually has some value. Otherwise, they don't have any value. And every single day, right, the option is going to decrease in price, right? The time premium, the time value is going to decay with every passing day. So options will lose value as expiration approaches, requiring precise timing. If stock is trading at 100 and you went out and you bought a 120 call, you need the stock to be at 120 or higher at expiration in order for you to make money, right? So every passing day that the stock is not moving towards 120, the value of that option, of that $120 call, is going to decrease, right? So if you're a net option premium buyer, time is working against you. So if you are going to buy options, right, instead of, let's say, buying 100 shares at 100, you bought a $100 call and you paid $5 for it. Well, now you need the stock to move higher. Otherwise, that $5 premium that you paid for that option every day is going to decrease in value until the day of expiration. And if the stock is less than $100 per share, the $5 that you paid for it will be worth zero. The option is going to expire worthless. Also, not only time that's working against you, volatility is potentially working against you as well, right? If you bought an option and you paid a premium for it, let's say even if the stock goes higher, or better yet, let's say you thought the market was going to decline, right? Stock is trading at 100. You think the market's going to sell off. You went out and you bought a $90 put that expires in 2 weeks. The next day, the market is flat. The following day, the market's down, I don't know, half of 1 point. The following day, the market is up half of 1 point. The day after that, the market is down maybe 1 point. If the market isn't moving with greater speed than what was being priced in at the time when you bought that put, volatility is going to contract, which means that the odds of that $90 put that you bought is going to decrease, which means the market is willing to pay less for that put, even if the market is moving in the right direction for you. If the market is moving down, but it's moving very slowly, volatility is going to come out, and that put that you bought is going to lose value. And on top of that, if 3 days, 5 days goes by, so that put is losing value due to time decay, and it's also losing value because of volatility contraction, right? How many times have you heard, or maybe you have had something like you bought a call, stock went up, but it didn't move fast enough, or you bought a put and the underlying didn't go down as fast, but it did go down and you still ended up losing money. That's because you had two things going against you. You got the direction right, but you didn't get the timing, and that cost you volatility risk, right? That cost you because volatility came out, time has passed, you got the direction right, but you didn't get the speed right, and that cost you money. So options require education and practice to use effectively. To succeed, start with simple strategy, buying calls or puts, or something as simple as covered calls. Paper trade to build confidence. This is important, right? Because, people go out and they look at some sort of a presentation where, oh, buy 100 shares, sell a call against it, generate a ton of premium. Sounds very simple. I'm all in. Next thing you know, they're buying some high flying stock no one's really cared about, just because it's in the news, maybe, or it's the hot thing today, right? You bought the stock, you sold the call, stock went down a lot, right? So you had the covered call working for you, but the stock sucks. Stocks went down a lot against you. And now you're sitting in a position where maybe your best bet is to, use some kind of stock repair strategy or something like that, right? So you need to kind of get an idea about, all right, if you're going to do covered calls, you need to understand, what works best for covered calls, what kind of underlyings you want to choose to do covered calls. Um, it's all part of risk management, right? Stock selection, strike selection, expiration selection, and we can talk about that more when we get to covered calls. You definitely want a paper trade just so that you get an idea of what to expect. Let's say you picked Apple. Okay, great. You think Apple is long-term bullish. You can use paper trade. There's a lot of simulators out there that you can use. You can simulate being long 100 shares, short, slightly out of the money call. Do it for 3 months. Understand how it works, right? You can look back and see, what happened to the price of the underlying. Did it go up? Did it go down? What happened to the call that I sold? Did it go up? Did it go down? Right? Do it several times over and over. Understand your cost basis. And then once you have a good idea about how these strategies work, you can potentially go out and try to use it with real money. You also want to study option pricing and the Greeks, the delta, the theta, the vega, the gamma. We talked about the Greeks just a couple of weeks ago or so. If you haven't checked out that video, please. I think there's value there. So understanding the why, right? Why options move and price the way they are, what affects the pricing of the options. This is all Greeks. Understanding that is going to really, really take your trading to the next level. Some real world application. Here's a scenario. You own 100 shares of XYZ stock at $50 a share, and you expect it to stay flat or rise slightly. You sell a $55 call for $2 or $200. That's what you collect in premium. If XYZ stays below 55, you keep the premium. If XYZ goes up and beyond $55 a share, you will sell at a profit or let the shares be called away, right? So if you bought the stock at 50, you sold a covered call for $2, your cost bases are now $48, right? 50 minus 2. Stocks above 55, you get called away at 55, you will have made not $5 but 7, right? So that's not terrible, right? You generate income while holding the stock. Maybe you sold this call that was 6 months out and you caught two more dividend payments in between, right? So you can enhance your returns not just by selling calls, but also by holding the underlying. So you got three potential streams of income. You have the dividend income, you have the premium that you collected for selling that call, and you also have realized capital gains. Right. So you generated income while holding the stock, demonstrating how options enhance returns in neutral markets. Maybe the stock didn't go up to 55 and you just caught two dividends and you got to keep the $2 premium, which is like the best case scenario. And then you can go out and sell another call. Maybe you capture two more dividends, collect another premium, and then eventually get called away. And that's how you can potentially enhance your returns long term. Some key takeaways, and these are all that we have covered today. Number one, leverage. You control large positions with very small capital that you are putting at risk. You also have to understand leverage, as I said, works both ways. You put up very little to potentially gain a lot, but if you're wrong, right, losses, you're that small capital that you're putting up is going to get hit pretty hard. So you do need to understand what's at risk, and you have to be okay with losing a big portion of that small capital that you have to put up, also known as time premium. Risk management. You can hedge your portfolio, or if you don't want to do it on a portfolio level, you can go and pick and choose what stocks you'd be willing at what prices, which stocks may have the most risk and whatnot, and use options to hedge individual stocks against price declines. You can also use options for income. You can earn premiums through selling strategies such as covered calls, iron condors, iron butterflies, straddles and strangles, right? If you're looking for near term, sideways, neutral, low volatility market environment. Flexibility is a great one. You can profit in any market condition. We can go down this path and talk about some pretty complicated concepts around, turning bullish positions into neutral and then eventually turning them into bearish positions. We do quite a bit of that on Discord. And if there's interest around the concept of flexibility, turning bullish positions into bearish and vice versa, we can definitely talk about that. I love these complicated concepts. Defining risk is another great one. Knowing your maximum loss up front, right? If you bought a stock and you had to buy 100 shares, put up $50,000, you're probably not risking full $50,000 because odds are the stock isn't going to go to zero overnight, right? But there's a chance that the stock can be down as much as 20% if there's some news that hits overnight, right? So if you don't want to risk that much, You can say, you know what, I'm instead of buying the stock and risking a big chunk, if I'm only willing to risk, let's say $2,000 for whatever the underlying may be. Let's just call it XYZ, right? I think XYZ is going higher. I don't want to put up $50,000 to own 100 shares. If I did buy it, I'd be willing to risk $2,000. But I am concerned that the stock might gap down, quite a bit, and my losses will be more than $2,000. Okay, what's my solution? I go out and I buy $2,000 worth of calls. What calls? In the money, out of the money, in the money. You get to decide, right? So you get to decide what you're going to buy and how much of it you're going to buy. You know that your total spend is going to be $2,000. Maybe you buy $2,000 worth of at the money calls, or maybe you get to do something like a 30-point wide call debit spread for you know $5, and you do four of those, which will also equal to total risk of $2,000, right? So there are different ways to deploy capital, but you know that the most you can possibly lose is the premium that you're going to spend on your um, option or a spread or whatever you're going to do. If you just wanted to take a pure speculation, right, and think about what are those crazy stocks that used to go up 70% overnight, the AMCs and the whatever Wall Street bets used to promote, right? You don't want to buy 100 shares, even if you think that this, stock is at 15 bucks a share. If I buy 100 shares or if I buy 1,000 shares, it's $15,000. How much can I possibly lose? Instead, you can say, you know what, I'm going to throw 500 bucks on it. If it hits, maybe that $500, becomes 20 grand. And with options, you can definitely get that kind of potential return with very limited risk, but it's a very high degree of speculation, right? So instead of throwing $15,000 around trying to play, um, these high flying, super high short interest names, you can use options. Yes, they're going to be expensive. Implied volatility is going to be through the roof, but you take a high degree of risk for potential high uh, rate of return on that small capital that you have to put up front. Cost efficiency, you get access to high priced assets, right, without having to put up all of that money. 100 shares of Amazon, I said this before, 100 shares of Amazon at $3,500, right? It's 350 grand. Even if you did it on margin, still have to put up $175,000. You can buy some call options, right? They're not going to be cheap, right? Maybe you buy a call option and an at the money call option costs you $30, right? $30 times 100 shares, it's 3 grand. It's probably, maybe it's more than that, um, but it's not, $350,000, right? So you get access to these high priced underlyings for a much smaller notional investment. I think that this covers it. I'm going to share this document with you guys. This isn't something super complicated. There are several reasons why we all use options. You probably have already named some or maybe all of the reasons why we trade options when I asked earlier on Discord. If you have discovered something new, great. If not, hopefully this was a good refresher for you guys. I'm going to share this recording as well. If you have any questions, you can always find me on Discord. Please don't hesitate asking questions, regardless of how simple or how dumb you may think your question is. I don't think there's such thing as dumb questions. So please ask questions. I encourage everybody to engage and ask questions, and we all get to learn something new. I promise you, there are many people in our community that may not be asking questions because they think, oh, this question is too stupid, or I don't want to sound stupid, and cut that out. right? So ask questions. Let's talk about it. I'm going to hop off here. Enjoy the rest of your afternoon. Take care of the risk. Profits will take care of themselves. Until next time, guys, trade them well. We'll talk later. Bye bye.